Hi everyone, welcome to today's video. So recently the Indian market and the US market, it fell quite aggressively. One of the prime reasons was that Janet Yellen, who is the US Treasury Secretary, she issued a very weird statement. And the statement was that regulators are not looking to provide any blanket deposits. Now, what is the meaning of this? In very easy to understand language, it means that the US people who are depositing their money in their US bank accounts, that money is not safe. And this statement is creating turmoil in the market. So let me very quickly explain you the macroeconomics behind it and why is this such a critical statement. So basically, the entire world's banking system now works on fractional reserve. So under this, what happens is that let's say that you deposit 100 rupees in your bank account in any bank, right? So what the bank is going to do is that it is going to take that 100 rupee and loan out 90 rupees and keep 10 rupees in reserve. So these are called as fractional reserve. Now the utility of this fractional reserve is very simple and easy to understand, that one day if you need this 100 rupee banks, you will go to the bank and knock that give my money back and give me interest on it also. So the bank will have to go back to its reserve and give you that money back. So that is how fractional reserve system in very easy to understand term means. Now think about it, this entire system actually works on trust. Why? Because 90 rupees has gone away from the bank. Bank cannot access this money immediately. So from time to time, the bank might have liquidity concerns. On the flip side, it only has like 10 rupees or 10, 15, 20% max. That is the reserve that a bank might maintain. So if there is a bank run situation, or if there is loss of investor confidence, or if there is a panic like situation or loss of investor confidence in a country's banking system, then a lot of people will start demanding their money back, and that can lead to a bank run problem. Now, exactly something similar has started to happen to a certain degree, not to an extreme degree, but to a certain degree in US and Europe. Recently in the US, a bank called as Silicon Valley Bank, it completely collapsed and there was a bank run problem there. And same thing happened with Credit Suisse, which is one of the biggest banks in Switzerland and one of the biggest banks in the world. So both these banks went under. So as a result, the investors stepped in and they asked that, US, what are you going to do about this? So the US central bank chair, Jerome Powell, he ended up issuing a statement that, everything is good and hunky-dory in US. There is no problem. In case there is a liquidity crisis, we will completely ensure that depositors' money is safe. But Janet Yellen has issued an opposite statement, and that is the reason why there was mass panic in the stock market. So I hope this critical concept is clear. If this was clarified in very easy to understand language, I would really appreciate if you can give a like. Now, moving on to the more important aspect, that think about it, that if the sitting regulators in the US, which control the biggest economy in the world, they are panicking, they are not able to assure the depositors. Now, you as a retail investor might be scratching your head that, bank mein paisa safe nahi hai. The bank money itself is not safe. Then where is it? I can put my money, at least I'll get the principal back. And on top of that, if I can get some growth, then nothing like it. So on today's video, I am going to discuss with you 6 very easy to execute options. I will show you how to invest in that. These are safe options. If you are looking to invest your salary, if you want to keep your money safe, or if you have parents who keep on asking you that, stock market niche ja raha hai, this, that, bank mein bhi paisa safe hai ki nahi, pata nahi, where should we deposit our money? So please show them this video. So a big thank you to Golden Pie for sponsoring this video. So all of us look for safe investments to make. So when we are starting out in the investment world, we want to invest our money safely. That is one of the prerogatives that we have. Our parents also ask us to do the same, कि पैसा नहीं डूबना चाहिए, कुछ भी हो जाए. So from that perspective, bond investing becomes really interesting concept because in bonds, the risk is relatively less. But many of us struggle in which bonds we should invest, which bonds are risky, less risky, more risky, where exactly should we invest in bond. So in order to understand better, you can check out our sponsors for today, which is Golden Pie, and there you can talk with bond experts in order to understand what type of bonds will fit your profile. So over to the main video, where I will also help you understand the entire ecosystem of safe investment options. So let's kickstart, and 6th option, let me start discussing it one by one. The first option is the fixed deposit. Now, there are 2 central points that you must understand about fixed deposits. I'll not explain what fixed deposits basically are, but people miss the timing of doing fixed deposits intelligently. So let me clarify 2 points. One is regarding when you should be doing fixed deposit, and second is that how safe are fixed deposits. So let me address both the points. So in terms of when you should be doing fixed deposits, The formula is very simple. You should do fixed deposits when the interest rates that you're getting on fixed deposits, those are higher than the target rate of inflation. अब बोलोगे कि okay, what have you said? This is looking hyper complicated. No, it is very simple. Hear me out. So take a look at this particular snippet. You will see that the Monetary Policy Committee, which is one of the arms of RBI, it decides what the target range of inflation in the economy should be. So that tolerance limit of inflation comes out to be 4 to 6%. What is the meaning of this 4 to 6%? Very easy कि यार इतने से price बढ़ गई अगर economy में, that if the price goes up by 4 to 6% every year, it is okay. It is not end of the world for us. People will be okay if this level of price rise happens. For example, if one apple last year used to cost 100 rupees, if it has gone up to 104 to 106, that is cool. So this is called as target range of inflation. Now ask yourself a basic question that if you go and do fixed deposit on HDFC Bank account or good corporate accounts, how much will you be getting? So I am assuming that you will be getting somewhere around 7.5%. So as per our formula, should you be doing fixed deposits now? So the answer for one part is yes, you should be doing fixed deposits. No doubt about that. Why? Because your return on fixed deposit is higher than the target range of inflation. So right now the inflation in the Indian economy and across the world is fairly high, but going forward the inflation will come down. So if you do a 3-year fixed deposit now, and if you are, let's say, getting 7.5%, and if 2 years down the line the inflation in the Indian economy becomes like 6%, then are you at a profit or a loss? The answer is that you are at a profit. Why? Because inflation has come down and you are in a way making 1.5% return. Ab isme mein tax facts I'm not including, but I hope you got the gist as to when you should be doing fixed deposit. So this is part 1. Now comes part 2, that okay, bank mein paisa dala, is it safe? I see a lot of small regional cooperative banks, this, that, which give me even more than 7.5% FD. For example, at this Falana Dinka bank, I'm getting like 11% FD rate. Should I go and put my money in that type of a bank? The short answer is no, absolutely not. And here is the reason why. So I will tell you 2 stories. So the first story is of Yes Bank. Now we all know that Yes Bank blew up in 2020. There was mass panic. Depositors ran कि भाई हमें पैसा दे दो from Yes Bank, and the Yes Bank was not able to give that money immediately. And there was something called as moratorium period that was introduced on Yes Bank, which simply meant that if you are a depositor of Yes Bank, that you know what, you will not be able to withdraw money as of now. Give us some time. We will infuse liquidity in Yes Bank, and then and only then you will be able to withdraw your money. So this is the narrative with which the Yes Bank crisis unfolded. People eventually ended up getting their money. Please note the word that the people ended up eventually getting their money. Yes, there was a moratorium period. There was a lot of trouble associated with the bank, a lot of negative news, but depositors got their money back. So now comes story 2, which is of Punjab and Maharashtra Cooperative Bank. Now, PMC Bank also faced somewhat of a similar type of a crisis that Yes Bank faced, but the depositors have still not received their money as a whole. For example, this is the snippet, and I'm reading it with you, that the latest news is that the retail depositors will have to take haircut of 30 to 43% as they will not get the interest for the first 5 years and 10 months and nominal interest of this. So itna loss ho gaya. For example, in very simple, easy to understand language, if you would have deposited 100 rupees in PMC Bank, then after interest rate and everything, the bank owed you 110 rupees, then you're not even able to recover like 90 rupees back. So that is the situation with PMC Bank. Now the interesting point that you need to understand is that on one hand we had Yes Bank crisis, their depositors got their money back, but PMC Bank depositors did not get their money back. What was happening? The reason was very simple, and it can be seen from this snippet, that Yes Bank was a fairly large bank. If the Yes Bank would have completely collapsed, a lot of people would have lost their money. It would have been haha, right? And a lot of problem. But small cooperative banks just going under, which is like 5% size of the Yes Bank, well, no one bothers about it, including the government. So to cut the long story short, just because you are getting like 10% in some cooperative bank as your FD returns, please do not put your money. You might lose that money in case that bank goes under, and very frequently cooperative banks go under even in India. So please remember this fact. Very, very humble request. That's part A. Part B. What about the fact that okay, मैंने HDFC Bank में I have a lot of deposits, उसमें FD करा लूँ. Should I go and do my deposits and fixed deposits in ICICI Bank, Kotak Bank, all these banks, all these good banks? Should I do it? Is there any risk? So yes, whenever you are investing your money, be it in fixed deposit, be it in stock market, be it in bond market, there is always a risk. That is the meaning of investment, that you're putting your money in order to grow it. And because you are intending to grow it, you are taking some risk. And as per government norms, if you have done fixed deposit in good banks, which is insured by DICGC. Now, DICGC is a subsidiary of RBI, which kind of protects the depositor's interest. That, for example, if I go and deposit up to 5 lakhs in HDFC Bank, now HDFC Bank has taken insurance from DICGC, then in case HDFC Banks kind of vanishes, then I will get that 5 lakh rupee back. Now, that is the mandate of DICGC, that it protects the depositors. But इसमें infinite limit होती है. The answer is no. This insurance by DICGC to some banks is only up to 5 lakh rupees. So to cut the long story short about fixed deposits, number one, please don't do FDs with Faltu ke bank just for high returns. It's just not worth it. Number two, please ensure that whichever banks you are putting your money in, if you are keeping in savings account, current account, then make sure that you do it under different family members' names. So for example, you, your wife, your son. So all of you will get that 5 lakh rupee benefit. And third and finally, please remember the timing, that right now it's a good time to do fixed deposit because the returns from FD is higher than the target range of inflation. So it should not be that you invest all your money in FD, but right now, good time to do fixed deposit because of the concepts that I explained. Now comes the second investable instrument which is relatively safe, and these would be treasury bills or treasury bonds. Now, treasury bills are bonds that are issued by the government. Now, this can be done by a state government or this can be done by a central government. Here, the money is directly controlled by the central or the state government, and it is very unlikely that the central government will go completely dissolved, right, and they will have like massive problems, or the state government will become completely bankrupt. Now, in case such a situation happens ki, state government khatam, central government khatam, then in that case banks will automatically die. So your FDs will also die. So therefore, if I have to keep my money safe, then I would rather buy T-bills over fixed deposits. But please hear me out. I'll explain both the pros and cons of FDs and T-bills. But very quickly, what are T-bills? So T-bills are bonds that are issued by central or state government. Now, what is bond? Bond simply means that the government will come to you. They will say that, you know what, here's a piece of paper. Here we have written that, okay, we will use money for constructing like 500 highways, and we are going to pay the holder of this bond a rate of interest of, let's say, 8%, and we will pay them after 2 years. So terms will be written, all these things. So you will buy this piece of paper, you will give the government, let's say, 1 lakh rupee. Government will pick this money, and after 2 years, you will get your money back with all these conditions being met. So that is what T-bill is. It is safer. Why? Because it is directly controlled by the government. And if the government goes under, then everything will go under. So therefore, T-bills are safer than FDs. That's the argument we can make. Now, does it mean that everything is great about T-bills? The short answer is no, because what ends up happening in T-bills is that there is a liquidity problem in T-bills. Now, what is the meaning of liquidity problems? So let's say that you have purchased a bond. Government came out. It gave you this piece of paper that, you know what, okay, number one, we'll pay you 8%. Number two, we'll pay you after 2 years. Number three, we'll build like 500 highways. You get very excited. You give the government 1 lakh rupee. And after that, what ends up happening is that your personal situation changes. You need that money after 1 year, right? Now, here the term says 2 year. So you will say कि अच्छा यार वापस कर दो, right? Then it becomes a problem. In fixed deposit, this is not a problem. You will pay a little bit of penalty. You will not lose your principal amount. You might lose a little bit of your interest in FDs. But on T-bills, if you trade them on the secondary market, that is, if you try to sell them like a stock, you might have to lose your principal amount. And that is precisely what happened with Silicon Valley Bank. So please watch my case study. I have done a very interesting case study on Silicon Valley Bank crisis. I will link it in the comment and description box. You can definitely check it out. That will help you understand more about government bonds and T-bills. So now you might have a natural question, how do I buy T-bills? So here is me explaining that entire concept. Just go and check it out, and you can easily do it through your trading and demat account. So now comes your third safe investment option, which are corporate FDs. I'm not saying corporate bonds, I'm saying corporate fixed deposits. Now, what are corporate fixed deposits? So you are doing bank fixed deposits, right? So similarly, if you are giving your money to, let's say, Bajaj Finance, they also have a corporate FD option. You give your money to Bajaj Finance. You can break it anytime you like, but please read all the details. So that is, in simple words, what a corporate FD is. What is the utility of corporate FD? To cut the long story short, corporate FD, at least of good corporates, it gives you flexibility. It offers you better yields than banks. And third and more importantly, you can actually track what is happening with that particular corporate. So let me pick the case study of Bajaj Finance corporate FD, and let me walk you through entire process, how you can buy it and what are some of the salient points that you need to check. So here you can go on Golden Pie and you click on Discover tab and you go on Corporate Fixed Deposit, Explore, and you will see a bunch of options. For example, here we are seeing Bajaj Finance. Now, all of us know that Bajaj Finance is an NBFC. It's a good growth stock. A lot of us have our money invested in Bajaj Finance. So let's quickly go through it. Here is the entire computation that has been explained, that compared to a bank FD, how much more money you will make. And then you can go and check out all the other important things. So for example, credit rating. It shows that how stable the company is. Second, lock-in period. Very, very important, because sometimes what happens is that you have to lock your money for 2-3 years. Exactly the problem with T-bills. So please remember that you're locking your money for an adequate period of time only. So this is the advantage of corporate FD. You can also choose your payout mode, that you want to get paid on maturity or you want to get paid on quarterly basis. Then again, some details and calculations might change, but you will be able to assess the entire overview. Okay, so now comes the natural question that should you even think about depositing your money in corporate FD? Yeah, we should go and buy equities only. What's the point of even going into corporate FD? Well, it's the risk profile. So for example, when you're going and investing your money in equity or stocks directly, it is much more risky because the stock can go to absolute zero and you and I will end up making no money. But corporate FD or corporate bonds are slightly safer. Therefore, I'm tagging them on today's video. Now also consider the practicality of it, that the corporate bond or corporate FD will go to absolute zero if the firm is having a problem. So it is always beneficial to go and check the performance of the company. So here you can simply go and check the financial performance of Bajaj Finance. So here you will see that it's a consistent profit making company, no problem there. Stock price can go up and down, that's not a problem. But as long as the company is not facing internal issue कि एकदम से बहुत सारा loss हो गया, infrastructure gone, loan default, this, that, then it becomes a problem. Stock price fall necessarily is not a problem. So this company looks healthy. Check its cash flow statement also. So here you will see that, okay, is the company getting money and keeping money that it is making? So the answer is yes, it is keeping money. Then from that perspective, if you're looking to do corporate FD, then do corporate FDs on good companies only that have a healthy balance sheet. Now, in case you want list of other AAA or very well rated companies on which you can do corporate FD, here is the entire list. You can go through it. So now comes the fourth option of safe-ish investment, and that will be corporate bonds. Now corporate bonds, corporate FD, almost one and the same thing. No major difference except for the lock-in period and the amount of initial money that you need to pour. So to cut the long story short, let me just walk you through a sample and then I will clarify these points. So here you can go on Discover tab and go on corporate bonds and press explore, and you will see that the ticket size is very big. This is the investment size. Now because the lock-in period for bonds is fairly high, therefore the yield offer or the return offer is also 12%. For example, here you will see कि यार 12% मिल रहा है, स्टॉक में इन्वेस्ट करने का मतलब ही क्या है? But the point is that here your money will get locked in quite aggressively. Very, very similar to how your money gets locked into government bonds. So yes, if you don't need this money immediately and you're okay with the lock-in period, then buying corporate bonds of good companies is sensible. For example, if I have to just quickly scan through this list, then which of it will I buy? So I will generally avoid capital or infrastructure heavy businesses. I will avoid small finance bank. I would prefer buying something like Union Bank of India or Bank of India corporate bonds. Why? Because it's very simple, right? It's very unlikely that Union Bank of India or Bank of India will completely go under. So from that perspective, I'm okay locking in my money. So if you want to invest in, let's say, Union Bank of India, just click here, get the other details, that what is the credit rating, and then you can also compare it with other similar firms. For example, Bank of Maharashtra, Bank of India, Union Bank of India, whichever fits your risk profile, you could consider making an investment there. Okay, so since we are speaking about safe investment options, what about gold? Because this is one of the frequently asked questions that I get. Okay, so let me just demonstrate one key point. I have made separate videos on sovereign gold bonds, so please go and watch it. That will be a much more detailed video. But see, this is what I would like to highlight, that if you consider the returns of gold, it's very dismal compared to another asset class which is called as equity. Now you will say that, okay, यहाँ पे तो safe investment की बात हो रही है. So how can you even compare it to equity? So okay, here we are not comparing it to individual equity. We are talking about overall Nifty and overall Nasdaq, right, which is the market indices. So to cut the long story short, the returns of equity are much higher compared to gold. So this is the first key point. Second, you will say that, okay, you know what, gold prices also go up, and if I buy something like, let's say, sovereign gold bond, then I'm making additional 2.5% over and above the market appreciation of gold. Please note your last sentence, that over and above the market appreciation of gold. So what is the underlying here? It is the gold prices itself. So if the gold price itself over a long term has done fairly badly, then as an investment class, I will not put my money in it. Now, people have a very fancy way of portraying gold results. For example, they'll say, "Acha, last 5 year ka returns aap dekh lo. Yeah, take the returns of the last 7 years or last 12 years. So, okay, you have to take a look at the fairly historic performance of that asset, especially if it has existed for a fairly long period of time. So out of all the investment instruments that I've discussed so far, gold will be my least preferred. Now comes the sixth and final, where you can invest your money. It is relatively safe also. It gives good returns also. So what would that be? So I would say indices. Now, what is the meaning of index? So for example, consider Nifty Small Cap 100. So this is the collection of top 100 small cap stocks in India. Right now, this is available at 35-36% discount. Now, do you think that all these small cap companies will vanish and this index itself will vanish? The answer seems like highly unlikely. So if you're a little bit risky investor, then you can definitely consider putting some money here. So on top of this, if you want to be relatively very less risky, then buy something like Nifty 50, which is the collection of top 50 companies in India, especially when it is trading downwards. So right now, the markets are well below their top. So from that perspective, it becomes a safer investment option. You can also consider Nifty Bs. You could also consider bank index, IT index. How to invest in that? I have put my answer in the description and comment box. You can check it out. And also, if you have stayed back and watched the entire video, thank you so much for watching. Do press the like button. It would allow these type of videos to reach out to more people. Thank you so much for watching again, and I'll see you soon.